Hey, Definers, quick note that this episode is sponsored by Climate First Bank, which is a values-based community bank focusing on environmental sustainability. Find out more about Climate First Bank at climatefirstbank.com. We think their mission aligns perfectly with the scope of this episode, and we hope you enjoy. All right, Definers, welcome back to Sustainability Defined, where Scott and I are here defining sustainability, one topic and one bad joke at a time. This is episode 65 on personal sustainable investing. Heads up, Definers, it's a doozy. Get comfortable. But Scott, tell us what this information-packed episode is going to look like.
All right, well, first, Jay, we'll start from square one, per usual. What is personal sustainable investing? Then what are the different types of sustainable investing? Third, we'll touch on how big is the sustainable investing space and why is it becoming bigger? Then what are the difficulties and downsides of incorporating more sustainable investing practices into personal investment strategies? How can individuals practice sustainable investing? How can you learn more about sustainable investing? How have sustainability defined? And myself and Jay, how have we done this? How have we practiced sustainable investing? And then lastly, we'll turn to our expert guest from Climate First Bank, Ken LaRoe, President and CEO, Chairman of the Board, and Founder. He's done all the things. So if you're interested in mission-based banks where you can put your checking and savings, stick around for that expert interview. But let's start from square one, Jay. Let's talk about what is personal sustainable investing. We're going to get to all the things people can go and do, but we got to give this background first.
Of course, you got to walk before you can run. So. All right, so if you want to learn more about how you can help the environment and society with your investments, we believe that today's episode will highlight the basics of sustainable investing and provide the tools and facts to allow definers to determine their own individual actions and opinions. In other words, we won't just get into what sustainable investing is, but also how individual listeners can do it themselves.
But first, a couple quick notes about what this episode is not. This episode does not focus on corporate sustainable financing or large institutional investors that invest on behalf of clients or members. It's more for your average person, your average definer, with some savings, some retirement accounts that wants to ensure more or all of their money is invested in a way that promotes sustainability, while also understanding what that means for their potential financial return. Now, important, very important, this episode is not financial advice. Please consult your financial advisor to assess the risk involved. We encourage you to do your own research as you make your own individual investment choices, whatever you want to do. You have been legally admonished.
All right. Yeah, Scott, for you and me, disclaimers, check.
Yeah.
Okay. Let's now start with the basics. There are many terms within sustainable investing that are similar but nuanced, like ESG investing, responsible investing, socially responsible investing, impact investing, and many others. We break many of them down in this episode. But first, this umbrella term, sustainable investing. It can be defined as an investing practice that takes a company or investment's impact on the environment and society into consideration. In other words, sustainable investing aims to bring investors financial returns and have a positive impact on the world.
Let's also define ESG, since we'll be throwing that around in this episode. ESG refers to environmental, social, and governance. These non-financial ESG factors are increasingly considered when making investment decisions. There's the E, or environmental factors. Think of things like climate change and air pollution. There's the S, or social factors, that relate to consideration of people and relationships. Think gender and diversity, human rights. And then there's the G, or governance factors, that relate to standards for running a company. Think board composition, political contributions, things like that. All right, Jay, let's go further. What are the different types of sustainable investing?
All right, Scott. So, of course, there are several different approaches that individual investors can pursue to align with their sustainable investing goals. In general, they fall on a spectrum between being on one side, motivated by financial return, and then on the other side by non-financial return. For example, being more focused on impact than financial return. These strategies can be applied across asset classes, so covering everything from stocks, bonds, real estate, angel investing opportunities, and more. Here in this episode, we are going to focus on 3 strategies for sustainable personal investing. Number 1 is impact investing. Number 2 is negative/thematic/positive screens. And number 3 is ESG integration. So let's dive into the elements, functionality, and examples of each strategy to understand the potential pros and cons of each type. Scott, start us off.
Right. And just quickly, we're going to get in later in this episode into pretty nitty-gritty detail about specific funds and things like that. This is more high level, the strategies, right? So first strategy, impact investments. As defined by the Global Impact Investment Network, or GIIN, impact investments are defined as investments made with the intention to generate positive, measurable social and environmental impact alongside a financial return. Impact investments is more on the non-financial return end of the spectrum Jay mentioned, compared to the ones we're going to talk about in a minute, thematic screening and ESG integration, because impact investments accommodate a range of financial return levels. All right, so there's a variety of pros and cons with impact investments. Jay, why don't you walk people through the pros?
All right. So, for example, one survey found 99% of respondents reported that their impact investments were outperforming or in line with their impact expectations.
Okay, so people are feeling good about the impact they're seeing from their impact investments. But let's talk cons. There are many remaining challenges still for impact investments. 47% of respondents of that same survey Jay mentioned found a significant challenge with suitable exit options, meaning ways to liquidate or dispose of the asset. Also, the largest challenge cited over the next 5 years for impact investing was impact washing. Jay, we've heard of greenwashing, right? This is a new one.
We have.
And it's related. It's the practice of overstating or falsely claiming benefits of a product or service. So the upshot here is that impact doesn't mean much if it isn't tracked with relevant metrics and sufficient monitoring. You can't just say, well, that's labeled an impact investment, so it must be good.
Right. And Scott, I have to be frank with definers. We're talking about impact washing. All I can think about at the moment is how I left some clothes in a washer before we started this episode. So note to self, let's move it to the dryer. All right. Number 2. Scott, you talk about number 1 as far as 3 strategies for sustainable investing, which was impact investing. Number 2 is negative/thematic/positive screens. So it's this idea of screening. So screening is a process that can help investors exclude or include specific values within sustainable investment portfolios. Number 1, negative screening excludes specific companies or sectors associated with activities such as tobacco or military operations, or with specific sustainability risks, such as avoiding coal or oil companies like Exxon altogether. Number 2 is thematic screening, which seeks to pinpoint trends that are helping our world to be more sustainable and invest in stocks that will benefit from their growth, such as exclusively investing in residential solar panel companies. Third is positive screening, sometimes called inclusionary screening, which aims to include best-in-class companies or initiatives associated with high-scoring ESG activities relative to other companies within the same sector. Think of this like investing only in companies with upper percentile ESG scores from ratings organizations like Morgan Stanley, Capital International, or MSCI.
All right, so just like we did with the last one, let's talk about pros and cons. Pros, negative screening. So negative screening is inclusive as it weeds out the worst of the worst based on the particular screening used and determines the rest of the companies to be acceptable. This can be beneficial to investors who are worried from other investing techniques. This can be beneficial to investors who are worried that other investing techniques may be too exclusive. It can also help avoid exposure to companies that are likely to perform worse in a low carbon future, such as oil companies. So then we've got thematic screening. Positive here is that you can capitalize on future trends. Other investments like mutual funds, they provide that diversification, but they can lack being tied to relevant events, policies, and themes. and then a pro with the positive screening. It quite literally allows you to vote with your dollar and play a role in accelerating those who are trying to be best in class on ESG. It also can help focus your portfolio on the companies that you think will perform best, given expected future trends in policy, culture, etc.
Okay, so we talked pros for each of those three. Just one quick con that applies to all of them. For screening generally, some critics state that screening can leave investors overly concentrated and lacking diversification in sector allocations that may actually be riskier than they seem. Mm-hmm. So I think that's a good nugget to chew on as you're considering these screening techniques. Okay, so that was 1 and 2. Number 3, as far as... Sorry, I'm just going back up to make sure I phrase this right.
We don't even remember.
Right. Okay, so that's numbers 1 and 2 as far as strategies for sustainable investing. Number 3 is ESG integration. In ESG integration, the investor considers the environmental, social, and governance factors that we discussed earlier alongside more traditional financial factors with the goal of better identifying risks and opportunities. In other words, here, investors don't apply social or environmental values to investment decisions, but rather consider whether ESG factors contribute to or detract from the financial prospect of a given investment opportunity. So, ESG integration is more on the financial return end of that spectrum we talked about earlier, with much less exclusion than the other 2 strategies we mentioned. An example is that a traditional investor who incorporates ESG information may consider investing in certain fossil fuel firms that perform best in the E for environmental factors, such as expected greenhouse gas emission reductions, or that score well in G for governance factors like a diverse board.
All right, so let's round this out. Pros and cons of ESG integration. So a pro is that S&P data showed that more than half of the ESG-linked funds outperformed the S&P 500 in the first several months of 2021. So the ESG-linked funds did better. But Jay, people might be saying, okay, Scott, what's an ESG-linked fund? And hard to know. There's a lack of regulation around these terms. So it makes it, we're going to get into this idea of a lack of measurement, lack of data, lack of information. It's really hard for regular investors to engage with this stuff and to trust what they're hearing. But another pro quickly is that investments with strong ESG performance, they're far less likely to go bankrupt. So if you're integrating ESG, maybe your investments won't just totally go kaplooey. And I did just say kaplooey. Cons.
That's the goal of any financial advisor,
yeah.
I hope, to make your investments not go kaplooey.
Yes, for sure. That should be a part of everyone's strategy. And then a con is investing in a socially responsible fund. It may include investing in corporations that may be unethical and benefit from environmental degradation, mining, logging, child labor. So it's important to make sure that the fund's core values line up with your own. Don't just trust that label like socially responsible fund. Mm-hmm. And then the other con here is that fees can be slightly higher for these ESG funds. And we're going to talk a whole lot more about fees, so stick with us. And higher fees mean that cuts into your earnings.
All right, Scott, remember you're in class and, let's say maybe you've skimmed the assigned reading for that day.
Right.
And the teacher comes to you and says, all right, class, pull out your pencils. We've got a pop quiz. Definers, pull out your pencils or note apps, whatever you're using these days. We've got a pop quiz. So we have gone over 3 different types of sustainable investment strategies. Let's just see how well you retained it. So, question number 1. Let's say you don't care so much about returns and are more focused on having a large impact that can be quantified. Which of those strategies would that be, Scott?
That would be impact investing, Jay.
Oh, he's 1 for 1.
Mm-hmm.
Question number 2. Let's say you want sustainability performance to be considered, but still want to be open to as diverse an investment portfolio as possible. What might that be?
Let's see, Jay. I think that'd be ESG integration.
I'm going to stop giving you feedback so I can give you your score at the very end of this. Let's say, Scott, for number 3, you just want the best-in-class performers to be a part of your fund. What would you say that might be?
Positive screen, baby. Best of the best.
Okay, with confidence. Number 4, what about if you want the worst performers excluded from your portfolio?
Negative screen. Get the bad actors out.
That's right. Okay. And finally, investing based on sustainability trends, what might that be?
Trends, themes, thematic investing.
Oh my goodness, folks. He has done it. He is 5 for 5. Scott, you've convinced me that you've done the reading, and we can move on to the next chapter of this set of intro notes, which is how big is the sustainable investing space? And then why is it becoming bigger?
I can't think of a better prize for going 5 out of 5. So thank you, Jay. Let's break this down. So scope of sustainable investing, it's huge. By the end of 2019, about 1 out of every $3 under professional management in the United States was invested according to sustainable practices. At the beginning of 2020, according to the Forum for Sustainable and Responsible Investment, or USSIF, U.S. assets under management that engaged in ESG investing strategies grew to $17.1 trillion, experiencing a 42% growth compared to the beginning of 2018. And another recent report found, looking ahead, that money invested in various ESG investment vehicles would increase 275% by the end of the decade. So this is a bit beyond personal investing, but you just see how big this landscape is.
Right. So let's ask what made the space for sustainable investing broaden and become a real feasible investing strategy. Well, I think we can point to international agreements and documents that are spurring sustainable investment strategies, right? So first we have the Paris Climate Agreement, which was adopted in 2016, which has encouraged more and more investors and asset managers to think about climate change impact. Next, we've got the UN Principles for Responsible Investment, or PRI, which set out 6 principles that institutional investor signatories agree to follow. The first principle is, quote, we will incorporate ESG issues into investment analysis and decision-making processes. Of note, in its Q4 2021 update, the PRI said that it had 4,375 signatories representing $121 trillion of assets under management. That number continues to grow. In the update, it said that in the last quarter, it had 218 global organizations just as new signatories.
Wow. And also of note here, Jay, is the Glasgow Financial Alliance for Net Zero. This started recently in April 2021. It brings together existing and new net zero finance initiatives in one sector-wide coalition, and it provides a forum for leading financial institutions to accelerate the transition to a net zero global economy. Its members currently include over 450 financial firms across 45 countries, responsible for assets of over $130 trillion. So you can see that these coalitions are just marshaling trillions of dollars towards ESG opportunities.
Mm-hmm.
And moving away from international developments and talking generally, more studies are emerging, suggesting that investors don't have to give up returns to work towards positive societal outcomes, as people realize that more people are choosing to invest their money in this way.
Right. We can also thank the Millennials. You don't hear that very often, Scott. Thank the Millennials for spurring growth in sustainable investing, perhaps after they've invested in the stereotypical avocado toast, right? Which is
delicious.
Right? So according to a study from Fidelity Charitable, an independent public charity, 77% of affluent millennials have engaged in impact investing against just 30% of affluent baby boomers and older generations.
Thanks, boomer.
And as more wealth is transferred over time to millennials, that could mean even more money invested with sustainability in mind and more avocado toasts purchased. From a legislation standpoint, previous legislation created obstacles for sustainable funds to be included in workplace retirement plans. But the Biden administration has announced that it won't enforce a previous ruling that largely excluded ESG funds from 401ks. So then we can see that legislative and regulatory activity could be a further driver for sustainable investing into the future.
Man, Jay, you think if retirement accounts and all that money, that's got to be trillions of dollars that could be unlocked, huh?
Absolutely.
So to tie it all together, interest in and action across the spectrum of sustainable investing is increasing. Why? Well, due to greater values-based decision-making made by all kinds of investors, spurred by changes in policy and public awareness. All right, next section, Jay. What are the difficulties and downsides of incorporating more sustainable investing practices into personal investment strategies? What's the flip side?
Right. Very critical question. Jason Jay, director of the MIT Sloan Sustainability Initiative, identifies 3 caveats to sustainable investing, including number 1, misalignment in the investor community. Number 2, outdated or inaccurate, quote, mental models. And 3, inconsistent measurement. So let's run down and just discuss them all briefly.
All right, so 1, misalignment in the investor community. So a key obstacle moving forward will be whether or not organizations and corporations will be willing to take more risk or less return to match the values of younger generations who are more concerned about social and environmental issues. So in other words, there might be investors out there that want to invest more like this, but the companies, the opportunities aren't there to meet them.
Right. Number 2 is this idea of outdated or inaccurate mental models. Jay, being Jason
The
Jay,
author, Jay.
Right, I'm not talking about myself in the third person, suggests his worry that many sustainable investors may have the wrong perception about the impact their investment may have. Common mental models include, quote, anything I do as an investor affects anything a company does. And, quote, if I want to make a better world, I should just sell bad stocks and buy good ones. In fact, a 2021 study from professors at University of Pennsylvania and Stanford University titled The Impact of Impact Investing found that ESG investors can have more impact by buying shares in, quote, dirty companies and then engaging with those companies' managements to adopt ESG-friendly practices. Perhaps a little bit counterintuitive there, Scott.
Yeah, Jay, because you think about all these people calling for divestment, right? And there's totally something to that. But then if all the ESG-minded people divested and all that was left was the people that don't care, there'd be no one left to push these companies, right? That aren't acting so well. So, okay, third is inconsistent measurement. So this author, Jay, not Jay, co-host extraordinaire, states that there is no quality, consistent data on how firms are doing on sustainability so that investment decisions can be made. So that's a downside here. You don't have as good a data. And these inconsistencies may occur due to different companies reporting information in different ways and with different levels of rigor. The lack of data is also part of why we're seeing ESG ratings from groups like MSCI and Sustainalytics varying widely. Research published by MIT's Sloan School of Management found that the correlation among ESG ratings was only 0.61 on average, whereas you compare that to credit ratings from Moody's and S&P, those are correlated at 0.99. They're basically the same between the different agencies. So it's certainly an impediment for regular investors, all kinds of investors, when you're trying to use these ratings from these organizations to help you invest, and they're wildly different based on the provider.
Absolutely. It's like getting directions, thinking you're going to the same place, but having different ways to get there, and you don't actually know if they're all going to eventually take you there, right? Super confusing.
It's like your worst nightmare on The Amazing Race.
Or at least like trying to make your party on time using Google Maps.
Right.
You know? All right. So right now, the U.S. Securities and Exchange Commission, or SEC, generally requires public companies to disclose ESG information if they deem it material to their financial condition, operating performance, or to risks investors may face. That leaves quite a bit of wiggle room. There's a lot of talk of the SEC soon requiring mandatory ESG disclosures. In fact, many other countries require these disclosures already. All right, let's talk about other issues with measurement here. There is a lack of third-party assurance for the information that is out there. 92% of S&P 500 companies published sustainability reports in 2020, while only 35% of reporting companies utilized external assurance, i.e. external validation, for their sustainability disclosures, which itself, Scott, is a little bit jarring. For those that do include assurance, it is often limited to one data point or perhaps just a handful of data points rather than all the data presented in the report. So again, we're talking about this idea of impact washing, Scott, and I think this is exactly what this stat is getting at.
Totally. And we talk a lot, Jay, about sustainability reports, and that's what people might use to better understand companies. But it's kind of mind-blowing that there's such a lack of validation to ensure whether what they're saying is actually true. And beyond that, there's also a lack of quantitative data, which is really important for investing. According to one analysis conducted by Goldman Sachs, only 11.6% of disclosed environmental and social metrics constitute performance data. Furthermore, only one of the 25 most commonly disclosed pieces of ESG information, greenhouse gas emissions, is quantitative, and it's 25th on that list of the top 25. So it can be difficult to incorporate sustainability into investing when the main data you have with which to make decisions is more about whether a company has certain policies rather than their performance in a quantified way.
All right, Scott, let's transition now and ask, how can individuals practice sustainable investing, right? So let's actually take this opportunity, quick breather. All right.
Yeah, like how can you? Now we're here. We did it. This was, I think, important context, right? Of like all the stuff we're gonna really get into now about what you can do. We needed this, but yeah, breathe. Oh,
totally. And Scott, I know we'll say this later in this intro notes. We say it in pretty much all of our episodes, but definers, go back to the episode notes we are gonna upload on our website, or just re-listen to this episode, because admittedly, this puppy's dense, right?
Yeah.
And we've packed it with a ton of good information. So if it doesn't sink in the first time, totally cool. Go back. I think there is a ton of valuable stuff here for all folks to glean. Okay, so back to how can individuals practice sustainable investing? So perhaps after hearing more about sustainable investing, you decide you do want to start integrating sustainable investments into your portfolio. Congratulations. If that's the case, we have pulled together some helpful tips to help you make your next steps. Morningstar, in fact, has outlined 4 steps when starting to add sustainable investing to your portfolio. So let's break these down.
All right, so the first one is discover what sustainable investing means to you. With any financial planning, it's important. Step number 1, establish your goals, right? So you might have specific things you want to avoid, like coal or oil companies. Or maybe you want to explore impact investment and seek investment in companies that are only going to make measurable, positive impact on the environment. These are questions you need to ask yourself as you start to explore sustainable investing.
Number 2 is understand what's in your current portfolio. It might be helpful to assess your current sustainability profile and how much of your profile may need to be reallocated. Do the holdings of funds in your portfolio align with your low carbon objectives? Do you prefer funds that pursue ESG goals by design? Great questions. One tool to help you do this is As You Sow's Invest Your Values tool. Again, hyperlinked in the show notes. Mm-hmm. You can enter in the ticker symbol of the mutual funds you invested in or that make up your portfolio. And then this tool will show you all the holdings in that fund, its performance compared to some benchmark, and then the tool grades it on several environmental, like fossil fuels or deforestation, and social, like guns or prisons, criteria. There are examples of funds being labeled as, quote, fossil fuel free that this tool shows actually have fossil fuel holdings. So really, you've got to do your homework. You've got to check. And this is a great tool to help you do that.
All right, so let's get into the third step that Morningstar outlines. Know the sustainable options available to you. Let's say you've pinpointed your individual priorities and evaluated the sustainability portfolio, and now you want to start making changes. Well, consider the strategies we presented today, impact investments, screening, and ESG integration, and become familiar with what each one represents in terms of the values and returns each of these can provide. And we're also going to discuss more specific options in just a minute, so stick with us.
Right, and so the fourth and final step via Morningstar is to make a plan to transition your portfolio. So now that you've become more familiar with your values, your current portfolio status, and what options are out there, it's time to start that transitioning process.
Right. And one of the important parts of transitioning your portfolio, we're going to focus a lot on more like investing and retirement funds and whatnot, but you also got to think about where your checking and savings account is, right? Because your bank doesn't just sit on that money, it loans it out. And how it loans it out might not align with your sustainability values. We're going to link in the intro notes to some lists of sustainable banks and credit unions. Bankforgood.org is one good resource. But we want to mention two specifically. One is our sponsor for today's episode, Climate First Bank, as well as Amalgamated Bank.
Right. So Climate First Bank is the nation's first climate-focused community bank. Since opening in June 2021, 43% of the loans that Climate First Bank has financed have been mission-aligned loans such as solar energy, lead retrofitting, and electric vehicle charging infrastructures. It also recently announced joining the Net Zero Banking Alliance, an industry-led UN-convened alliance of banks worldwide committed to aligning their lending and investment portfolios with net zero emissions by 2050 or sooner. Next, as Scott mentioned, we have Amalgamated Bank, which calls itself America's socially responsible bank and is America's largest B Corp certified bank. It's a mission-driven, union-owned bank with branches in several large cities.
And Jay, let's actually talk about how people can find other mission-driven banks, because those are two. But another way you can do this is look at the 101 banks that, as of this recording, are part of the Net Zero Banking Alliance. They're from 40 countries. They total $67 trillion in assets, which is about 43% of global banking assets. You can also look at B Corporation's website, where you can find the many banks globally that have B Corp certification.
Third approach, Scott, we just can't help ourselves.
We can't.
You know, we're here to help. A third approach here would be to look at the 275 signatories representing $72 trillion in assets of the UN's Principles of Responsible Banking. Yet another avenue is looking at the members of the Global Alliance for Banking on Values, which is a network of independent banks using finance to deliver sustainable economic, social, and environmental development. But definers, regardless of who you use, if you want to see that bank's performance, bank.green is a good site to look it up.
And Jay, we want to point out that as you take all these steps, you can try to do it yourself, or you can work with a financial advisor or managed fund. And of course, the less you do yourself, the more likely there will be fees, which at a younger age, that can really add up, given compounding interest, even at something like 1% of the managed funds. But we want to say that if you have a financial advisor, that can help mean less stress, take less of your time, and help you see new opportunities. So we hope that going through these specific options, they can help jumpstart or enhance your sustainable investing no matter what approach you take. But we want to cover all the different approaches and try to be balanced about the pros and cons of each.
Right. So let's talk about potential options here, Scott. First, maybe you want to find a financial advisor that's focused on ESG. Well, there are several tools out there to help you find one. The Certified Financial Planner Board of Standards, Inc. lets investors filter for socially responsible investing to find certified planners nationwide who offer these services. Another option is the nonprofit Green America's listing of financial planning and investment consulting firms. Advisors listed here are certified members of Green America's Green Business Network or are members of USSIF, a sustainable investing trade group that we mentioned earlier. XY Planning Network, a member-based organization of fee-only advisors, has a Find an Advisor portal where you can enter SRI/ERG/ESG as a keyword search.
Right. And we also found some financial advisor organizations that focus on sustainable investing, including Tribe Impact Capital, EQ Investors, NIA Capital, and Blue Sphere Wealth. So there's no lack of options when it comes to trying to find an advisor. But once you find one, make sure their disciplinary history is clean. You may also want to ask them how many clients they've helped create ESG-focused portfolios. You could ask them, well, what's your approach to ESG investing? But ultimately, you want to share with them how you want to approach it and make sure they can accommodate it.
A lot of the big banks now offer sustainable investing assistance as well. We found sustainable investing sites at Bank of America, Citibank, JP Morgan, and Wells Fargo. So if you're already with one of these bigger banks, they have programs that can advise you. If we didn't list your bank, you can ask them what advising and services they offer in sustainable investing. And quickly though, one note on the big banks, while they offer sustainable investing, they still use a lot of their capital to fund activities that accelerate climate change. Consider how one study found that in the 5 years after the Paris Climate Agreement was reached in 2016, the 60 largest banks globally invested $3.8 trillion in fossil fuels.
We've said trillion a lot, Jay. This is maybe the one time we said trillion where we're like, shoot.
Yes.
The other trillions were good. This is not a good trillion.
That's right.
All right, so that being said, the big banks are starting to act. Many have large sustainable financing goals where they're actually saying we're going to invest trillions towards sustainability projects and portfolio emission reduction targets. But these don't necessarily mean less financing of fossil fuels and other activities that exacerbate climate change. In January 2022, so hot news here, Jay, Citi got some positive press for setting an absolute emissions reduction target as opposed to an emissions intensity target, right? So Sierra Club put out a press release applauding the move for, quote, surpassing the low bar set so far by its peers. Definite shade there. Yeah. But also said that Citi should commit to no investments that expand fossil fuel production. So absolute reductions, better than emission intensity targets. But still, even if you have an absolute one, you could still find a way to invest in fossil fuels, right? If you want to be totally sure your money in your checking account, your savings account, things like that, isn't being used to invest in fossil fuels, it's best to just go with one of the mission-based ones we mentioned earlier.
Now, let's say, definers, you don't want a human active advisor because perhaps they have propensities for bad jokes. Mm-hmm. Then two options you have are RoboAdvisors that put together portfolios of various funds that you can buy into. And the other option is simply to buy the funds yourself and make your own portfolio. First, let's talk RoboAdvisors. Betterment offers several impact funds, including a climate impact portfolio, a social impact portfolio, and a broad impact portfolio. The goal with these funds is to allow for investors to have a socially responsible investment portfolio while still having a low-cost, diversified investment strategy with tax optimization.
Right, so Betterment is just one of these robo-advisors. It's a popular one. They're using computer algorithms and advanced software to build and manage your investment portfolio rather than an individual human doing it. So there's less of a personal touch, but on the positive side, the management fee tends to be lower. With Betterment, it's only 0.25%. There are also some that charge the management fee as a flat rate rather than percentage. Some might prefer that. One example is LVest, which was built by women for women. Its investment algorithm factors in important realities for women, such as pay gaps, career breaks, and longer average lifespans. Its plans range from $12 per year to $97 per year, and it has an LVest impact investment portfolio.
Now, of course, let's say you're fresh off watching Wolf of Wall Street. You could also set up your own portfolio made up of funds as well as individual stocks. When we talk about funds, we are typically referring to exchange-traded funds or ETFs or mutual funds that are diversified and meant to perform similarly or better than the stock market overall. To simplify things, we'll be using ETF and mutual fund interchangeably. In short, it means an asset made up of many individual stocks and bonds so that you have diverse exposure. There are many funds to choose from since at the end of 2020, the group of sustainable open-end funds and ETFs available to U.S. investors numbered 392, up 30% from 2019. So the question is, Scott, how do you find and choose from them?
Right. Well, we mentioned that Invest Your Values tool from As You Sow. You could use that, see the ones that are in there, including the ones that rank the best. You could also review ratings from independent research firms like Morningstar. NerdWallet has a listing of ESG funds that are highly rated and low cost. By low cost, we mean low expense ratio. We're going to get into that in a minute. You could also seek out funds focused on specific issues. For example, the Pax Elevate Global Women's Leadership Fund, ticker symbol PXWIX, invests in the highest rated companies in the world for advancing women through gender diverse boards, senior leadership teams, and other policies and practices. Or maybe you're interested in water. There's the Ecofin Global Water ETF, ticker symbol EBLU. It's a passively managed fund made up of companies it believes are positioned to benefit from the pursuit of solving the water supply/demand imbalance.
Okay, so let's, for example, Scott, use Aspirations Redwood Fund with the ticker REDWX as an example of a fund you could include in your portfolio and explore how it stacks up on key variables. I think we both found this to be a super helpful, just kind of step by step.
Right. You could do this with each fund that you kind of find, right? So let's do one.
Exactly, a little bit of a case study here. So quickly, just some background on the fund itself. The Aspiration Redwood Fund looks at multiple ESG factors to find companies whose management understands that smart long-term thinking is not only the right thing to do, but right for their bottom line. Okay, so minimum investment of Aspiration's Redwood Fund, $10.
Easy.
Right, $10 easy. Let's talk about fees. There is the fee that all owners of the funds pay, and then there's the management fee, okay? So first we have the expense ratio, which is the annual fee charged to fund investors.
So Jay, you can't avoid this one, right? This is, if you own the fund, you pay.
Exactly. So for example, if the expense ratio on a fund is 1% and you've invested $10,000 into the fund, you're paying $100 a year. The expense ratios are lower for passively managed funds, which means there's no one actively managing the fund to try to beat the stock market, right? The expense ratio for the Aspiration Redwood Fund in this instance is 0.5%. Now, regarding the management fee, you decide how much to pay Aspiration. It could be zero. It's totally up to you. And then, of the amount that people choose to pay them, Aspiration gives 10% to charity, right? So Scott, we've talked minimum investment, we've talked fees. What's next?
Right. And just so people know, I mean, the fact that Aspiration lets you choose, that's not typical. But just you want to look at that expense ratio, that management fee. Now, performance history, what's nice about the Redwood Fund is that it actually started in November 2015. So there's a bit of a track record to look at. But some of these ESG funds are just so new, there isn't much historical performance to consider. So it can be a downside for some funds. And then there's ratings. So we put that REDWX ticker into that As You Sow tool, and we saw it had grades of A's and B's on its various criteria. Pretty good. And then Morningstar gives it 3 stars out of 5 for the fund's historic performance relative to its peers. So you might want to see, how is this fund done in terms of its returns relative to similarly situated funds?
Right. And of course, other than funds, you could look to include in your portfolio the buying of individual stocks, although of course, this is more risky. If you're going to invest in an individual stock, do your due diligence on, among other things, that company's commitment to sustainability and its plans for the future. You could also be guided by certain certifications like companies that are B corporations or those that have a certain legal structure like public benefit corporations. And it doesn't have to be stocks of big companies. You could go all Shark Tank about it and invest in startups that have a sustainable angle, become your own little Mark Cuban.
Totally. Although I have to say, Barbara's my favorite shark. I don't know if I've mentioned that to you, Jay.
Well, you know what, Scott? Let me just share a little brush with greatness. I've met Mark Cuban's wife. Therefore, I'm going to go ahead and say that Mark's my favorite.
Is she cool?
Super cool.
Awesome. Okay, so there are platforms out there that allow you to find the startups we're talking about that you could, it doesn't just have to be the big companies, right? So one is WeFunder, which allows you to invest as little as $100, and you can filter on their site to just see the public benefit corporations, the B corporations, and other filters. Another is Republic. It has several impact filters, including eco, social, and minority founders. The companies on there set their minimum investment amount. We saw one for as low as $50. And rather than some fancy silicon startup, you could also provide loans to people running businesses in underserved communities through platforms like Kiva.
Now, definers, importantly, if you're going to invest in a startup, it's important to know whether you're an accredited investor or not. Accredited investors made $200,000 in income the last 2 years and will do so again this year. Or, if not that, they have a net worth over 1 million buckaroos. Mm-hmm. Now, most people are not those things, including Scott, unfortunately, you and I.
Nope.
The good news is that Congress changed the law, so now non-accredited investors can be included in crowdfunding of startups. These websites make clear which offerings non-accredited investors can participate in and help them follow the complicated formula for the maximum they can invest.
Okay, and regardless of how you invest, explore options to vote on shareholder resolutions. Shareholder activism is increasingly becoming a way to push companies toward more aggressive activity on sustainability. People forget about this aspect. For example, Cisco, a global food service leader, it had no company-wide greenhouse gas emission reduction goals. And in November 2021, 92% of Cisco shareholders, which is an amazingly high number, voted in favor of a resolution asking Cisco for Paris-aligned, net zero targets, an aligned climate transition plan, and annual reporting of progress.
Unfortunately, though, individual investors tend not to vote on shareholder resolutions. One recent analysis found individual investors' votes only represented 28% of their total shares. Also, those managing index funds like BlackRock and Vanguard have failed to vote for environmental resolutions in the past. But the good news is that they are starting to get more active. Collectively, more asset managers voting has resulted in the average vote of support on climate-related proposals leaping to 41% of shares voted in 2021, up from 31% just the year before.
Jay, I have to tell you that for my bar mitzvah, one of the presents I got was Disney stock.
Oh, baby.
Right? And I don't know if you follow Disney stock, but that was a pretty good stock to get when I was 13, given what's happened to it. But I do feel like I've gotten a lot of emails and stuff about voting on certain things by proxy and whatnot. I've never done it, but maybe I should try, given what we're talking about here.
Scott, I the same thing. And it's kind of like, you're in just like operation mode. You've got emails that come in. You're just, choose.
Living my life.
Right. You got to like decide where you invest your attention. But like now that we're talking about it, you see those emails come through and now it's like, well, hell, maybe it's time I actually start voting.
Yeah. And of course, sustainable investing is just helping you use your money to advance sustainability, right? Big picture, regardless of whether you currently have funds to invest, you got to remember there's still a lot that can be done, arguably with bigger impact than what your money's being put towards, right? You could advocate for policy changes. You could talk with others, friends and family about sustainability issues. You can make changes in your personal behavior to reduce your impact. So let's not forget about that. And no worries if you don't have money right now to invest in the ways we're talking about.
Mm-hmm.
So how can people learn more about sustainable investing? New section here. Well, you could get your Fundamentals of Sustainability Accounting, FSA certification. It's offered by the Value Reporting Foundation. It helps you to understand the Sustainability Accounting Standards Board, or SASB standards, that identify the ESG issues most relevant to the financial performance of 77 industries, as well as understand more generally the link between financially material sustainability information and a company's ability to drive enterprise value. Now, I have the level 1 certification. There's 2 levels. I'm hoping to pass that level 2 later this year, and then I'd have the full credential. I want to also give a hat tip to FSA because I totally rated my study guide to inform some of these intro notes.
All right. So another option here is to take an online course or join support groups. The nonprofit Invest for Better gives women the confidence, skills, and encouragement they need to take control of their assets and use them to influence the things they care about. One way it does that is with its Invest for Better circles, which are small peer-to-peer learning and activation groups. Now, there are truly so many guides out there now, and we've linked to many of them in our intro notes since we looked over a bunch of them to inform this episode, Scott, on top of your study guides.
Mm-hmm.
So definers, Google around for those, or of course, perhaps our first suggestion, go to this episode's webpage on our website at sustainabilitydefined.com to see all these links.
All right, Jay, I think this might be maybe the coolest part of the intro here. And our last section is how is the podcast investing its money in the ways we're talking about? How are you and I doing it? And how are we not doing it? So,
right, yeah, exactly.
Yeah. So, Jay, start with the podcast. Tell us about what we're doing with our podcast money.
Right. So first things first, Scott, we get our revenue from sponsorships. We then, of course, use that money to pay our employees like Amelia and Keaton. Now, Scott, you and I haven't paid ourselves since we started this, which is over 4 years, right? Of course, we can take out a few Zoom dinners we've had with the two of us and our significant others, but over time, we've accumulated enough money in our business bank account that we decided it's time we should invest it. And in fact, that realization helped inform this episode and catalyze it. So we have a business account with Chase. We did this because they've got branches near us where we live in Denver and DC. However, as you might have guessed from the content of this episode thus far, we are looking into moving our money into a more mission-driven bank.
Right. So let's tell you all about our saving and investments plan, right? So we're not going to invest all of it. We got to hold on to some of it. So if the sponsorships dry up, we can still keep going and pay the expenses. We can still keep paying employees.
Zoom dinner here or there.
Dinner here or there. You need a rainy day fund, of course. But most of our money will be invested in a diverse array of index funds with low expense ratios. Hopefully you remember that when we talked about it. We plan to invest the money on our own to avoid the management fees we talked about. And we plan to slowly invest the money in equal installments every month until we've hit our target investment amount. That's an important point. You don't necessarily need to time the market with these sort of investments, right? Just get it in there. And here's our planned breakdown when we looked at what are funds that score decently well in As You Sow's tool, have low expense ratios. Well, we said, okay, we want to have maybe about half our money in what we call large blend funds. They're made up of lots of large U.S. stocks. So ticker symbols DSI, ESGV, SUSA, all examples of types of funds we would invest in there. We want to have 25% that we're going to direct money towards foreign large blends. So foreign large stocks. Maybe the U.S. stocks aren't doing so well, and that means the foreign stocks are doing better. Get that diversification. Okay, so ticker symbol VSGX. And then there's foreign large blend. We want 25% in there. You could imagine where the U.S. stocks aren't doing so well, but the foreign stocks are doing better. You need that diversification. Ticker symbol VSGX would be a good one there. And then foreign developed stocks, about 15% we would put in there. Ticker symbol ESGD. And then diversified emerging markets, 10%. So some developing markets and countries, companies there. Ticker symbol ESGE is an ESG aware fund in that type of fund.
On top of that, we plan to take at least $1,000 and invest it in individual company stocks that align with the values of the podcast and that are trying to advance sustainability. We also plan to take at least $1,000 and invest it in early stage companies and become those aforementioned Shark Tank investors ourselves.
We're tough negotiators, aren't we, Jay?
Oh, don't you dare try to counter us.
You want how much for the for 5% of the company?
Did you at least bring free samples?
Yeah, right, exactly. So, definers, let us know your thoughts, all right? Tell us if you disagree with our index fund investment approach. Tell us if you think there are individual sustainability-minded stocks we should invest in. Tell us if you know of early-stage companies that could take an investment from us and have advancing sustainability as part of their mission. And I think even better, Jay, which I think we got to put this on our Instagram, a call out for this. If you're a definer, you're a listener, and you have a company that we can invest in, that'd be great. I
love that.
Right? We wouldn't have a show. We wouldn't have this money to invest if it wasn't for our listeners. So let us know if there's something we can contribute and invest in that you are doing. And we plan to do an update episode at some point, like a year from now, where we tell you, how did all these investments do? What did we do right? What did we do wrong? So that should be pretty cool.
Awesome. All right. So, Scott, I think we want to just, as you mentioned earlier, just kind of jump in and perhaps just offer our own little personal takes on what we've been doing, perhaps outside the podcast. I know you've got some great points to run through. I will say, and I think we would both say, we're perhaps not the best when it comes to personal sustainable investing. Not to say that we don't intend to improve. You got to start somewhere, right?
Right.
And I think we both learned a ton from this intro notes, right? So I think we can both come out of this better ourselves. I think for me, when I'm thinking about the main personal sustainable investing strategies that I pursue, kind of falls back to real estate or perhaps real assets. So I bought a house kind of right at the beginning of COVID. And for me, relative to my paycheck, a lot of my expenses I think of as investments that go into my mortgage payment that, of course, build equity in my home. I think of that as a sustainable investment because of the home that I chose to buy, which is located, one block from a mass transit station. It's walkable to many other amenities that don't require a car, etc. So I kind of think, okay, well, I've got, some of my money going to my mortgage to build up equity in what's hopefully a sustainable asset. On top of that, and related to this real estate, is a new set of solar panels that I actually had put up on my garage and on my house, which was a pretty cool financing tool where basically The panels themselves were, quote, or were rather installed for, quote, free. But in order to pay them down as well as paying my utilities, I am capped at a maximum per month for both my energy usage and the principal payments for the solar panels, which means that, as I'm paying my utility bills, I am gaining equity in the solar panels themselves while also benefiting from solar power. So I think those are kind of the main ways I'm thinking about personal sustainable investing. I know I've done some individual stock investing and ETF investing in the past that have not necessarily been along one of the approaches that we've mentioned in this episode, but as we talked about, plenty of room for improvement. So that's kind of a little snapshot into my finances. Scott, what do yours look like?
Well, Jay, just a quick question with the solar panel thing. I mean, was it an actually good investment, like objectively, or was it more like, I want solar panels on my roof and it's it kind of is a wash financially, or like this actually saves you money too?
It's so cool. So basically and it was a really, again, nifty financing tool, but effectively I am able to get cheaper energy from these solar panels than from my typical utility provider, from the electricity that they provide. So I am actually getting cheaper electricity while also gaining equity in the solar panels themselves. So
it's a twofer.
Really it is absolutely a twofer.
I love that.
Yeah.
All right. Well, a couple things that I want to share with the definers. So one thing is that I, like you, Jay, I haven't done the greatest job historically investing my money with sustainability in mind. I've had a Roth IRA for many years. People at any age can contribute to this. You just need earned income. The nice thing is that the growth is not taxed. I admittedly left it to our family's financial advisor. Invest it, where it's growth strategy and whatnot. But I didn't tell him I wanted him to invest with sustainability in mind. And he charged me a 1% management fee, which, is pretty standard. But I've actually said, okay, enough of that. I want to take over. I want to manage it in the way I want and not have this management fee. I actually have a Roth now with Wealthfront. So it's one of those RoboAdvisors we mentioned earlier. And they actually now have a socially responsible investing option, which wasn't the case when I put my money there initially. I actually just clicked edit portfolio, do it with the socially responsible investing option, and it happened. It was very easy. It was quick. One thing they noted, though, is that some asset classes for them, like foreign developed, emerging market stocks, they didn't really have an ESG alternative. And we noted some ticker symbols that do have ESG in mind that are those asset classes. But you definitely have less options. So that's something to keep in mind. I would say personally, one thing that I haven't done so great is setting up automatic payments to my investment strategy, as well as making sure the investment strategy to which the automatic payments are going are being made with sustainability in mind, right? So I'm now in the process of making sure, okay, a certain percent of my money goes towards these investments. I'm not trying to time the market necessarily. I'm just making sure, there's a regular cadence to putting it in the way that I want to do it. And now with these investments that I'm making on a regular basis, I'm choosing them, right? And I'm actually doing it through Chase. We've talked about it, I might want to move away from that. But the nice thing is Chase and most of these trade platforms, because of things that came up like Robinhood and others, everyone kind of got rid of their fees for the most part. And so through these banks and others, you can very easily set up self-directed investment accounts. And so through Chase's tool, I actually said, okay, they let you look up different funds. I said, just show me the ones that are socially responsible investments and low fees, right? Less, and for them, that would mean less than a 0.5% expense ratio. And when I chose those two filters, it went from 2,515 options to only 129. So this goes back, Jay, to one of our earlier points that when you start investing in this way, sometimes you have less options, and that's something to think about, right? And I have to say, this whole thing that I'm doing now of self-directing my investments, choosing the funds, and trying to keep them diversified and blah, blah, I probably would feel less comfortable making these decisions if I didn't have my brother, who is a wealth advisor, to run the decisions by before I invested, to call if I'm concerned or confused. So there's something to be said for having that human to call and walk through your concerns. So I hope that's helpful to share that personal information. And Jay, we've shared a lot, huh? There's a lot here.
Well, and Scott, I'm curious, like, was there a point at which you said, I feel comfortable enough doing this on my own? Because I'm sure there's like a sense of, what's the word I'm looking for? Inertia, right? If you've got your funds invested and perhaps nothing's gone wrong, right? I mean, I presume that takes like a real concerted effort to say, I'm actually going to switch all this up.
Yeah, I think part of it was just more reading, talking with my brother a little bit, in the sense that, like, these wealth advisors, they're not trying to beat the market, right? They're just putting your money in funds based on what you are telling them is your risk tolerance and your goals. With a little bit of reading about the different funds, you can identify your own portfolio that does exactly that, right? And as long as you're comfortable, maybe if you don't have a brother like mine, you're more comfortable just writing it out and reading things and kind of answering your own questions, you can do that. But yeah, you're right. There is a bit of inertia. But once you get over that, I mean, that management fee, the more fees you avoid, especially at our age, Jay, I mean, this stuff adds up.
Mm-hmm. Absolutely. Okay, so listeners, pat yourself on the back. This has been a ton of information.
Totally. And longest intro ever, I think, Jay, huh?
It is. I think by a good margin, and I think for good reason.
Yeah.
So again, listeners, I suggest, if it's not listening to the episode over again, which I know I've done on several podcasts, because there's so much there you got to absorb, and perhaps you're like driving or you're doing something else as you're listening, definitely replay it. Of course, you can always go to our website, check out our show notes with all of our hyperlinks. That's going to be at sustainabilitydefined.com/personal sustainable investing to see all of the intro notes we've got here. But I think there is a ton to learn, both for definers, Scott, for us too. And I'm, really thankful we've put in the work for this episode. I think it's going to benefit a number of folks out there.
Totally. And when you say show notes, Jay, just to be clear to everybody, it's basically a transcript with hyperlinks, right? So you could read it instead of listen to it. But
why would you want to avoid our
the bad jokes aren't in the transcript. All right. So expert guest, Ken LaRoe. Ken is a serial values-based bank entrepreneur, having founded, operated as chairman and CEO, and successfully exited 2 community banks in Central Florida. The second of those community banks, First Green Bank, was the first bank in the United States with a stated environmental mission. So his third bank here is Climate First Bank. And this is going to be great, Jay, because we talked a bit about how it's really important to think about where your checking and savings is going. And I would say this is almost the most tangible, like almost easy thing you can do, right?
Yeah.
Investments, overwhelming, I could lose money. This is just about putting, your safe stuff. And so we'll hear more from him about what's involved in doing that, as well as what's involved with running a mission bank like this.
Here we go. All right, definers, we have arrived to our interview portion here on our personal sustainable investing episode. We can't wait to dive in with Ken LaRoe, who joins us from Climate First Bank. He is the founder, CEO, and chairman of the bank. So he's got all kinds of expertise that we're excited to learn about. So first off, Ken, you are a serial values-based bank entrepreneur. So talk to us a bit about how you got into starting values-based banks. Were you perhaps working in traditional banking and then saw a market opportunity?
I had decided that I wanted to get into the banking business with my own bank pretty early on. I accidentally got into the banking business out of undergrad school because it was the only job I could find. But once I got in it, I really liked it. And I left banking when I was 32 years old, after I'd been in it almost 10 years, and went to law school. But in law school, again, decided I wanted to start my own bank. So I kind of geared my studies towards banking and law, got out, took a job with a regional, and then started working toward doing my own bank. And I started my first bank in '99 as just a traditional Florida chartered community bank. We grew it to about $400 million, and I sold it in 2006. There was no pretense to anything sustainable or environmental or anything. But I had always considered myself an environmentalist, even though I didn't really know what that meant. But after we sold my first bank, I had a non-compete, so I couldn't get back in it for 3 years. So my wife and I bought a little mini motorhome, and we circumnavigated the country.
Love that.
And before I left, my brother gave me the book, Let My People Go Surfing. Have you guys read that? Yeah.
Oh, love
it.
Yeah.
And my brother's a huge Patagonia fan, but oddly enough, he's a huge right winger, and it's, that seems like a contradiction. But I read that book and it inspired me, and I thought, oh my God, this is the answer. I've got to do something that gives back other than makes a bunch of people a bunch of money. And I floated the idea by my best friend, whose opinion I really value, and he came up with the name First Green Bank. And then my wife designed the logo sitting at our dining table one night. She's a graphic artist as well as a physician, and as well as just a brilliant person. So that was the genesis of First Green Bank. And it was really, really tough. We filed our application in 2008. And the week after we filed, Washington Mutual failed. So, you can kind of imagine what it was like chartering a bank in the worst financial crisis, we've seen in our lifetime for sure.
Mm-hmm. And so when you started it, did you think it would be something big and you would start 3 banks? Or was it more, I just need to do this because I sort of feel this calling, I just read this book, and we'll see where it goes? Like, did you think, oh, I'm actually going to make a fair bit of money and do something good at the same time?
I mean, your synopsis is perfect. I thought this will be a home run, so therefore it'll be a good investor thesis.
Yeah.
And we'll be doing good and giving back in the process. The thing is, in 2008, though, nobody really knew what values-based banking was. It was really in its infancy. I felt strongly about it, but didn't know where it was going to take us.
Mm-hmm.
So it really became a journey. And in that process, we joined the Global Alliance for Banking on Values. And I was asked to sit on the board in, I think it was 2014. And I sat on the board for a couple of years, which was an amazing experience. But we sold the bank in 2018. And it really broke my heart. I really felt like I had let my team down, the community down, the world down, and all that. And my wife and I got another mini motorhome, and we circumnavigated the country again. And I did just a ton of soul searching. And one day it'd be like, yeah, we're going to do this again. The next day I was like, no, I can't. I don't have it in me. I'm 62 years old. I can't do it. And then finally she said, look, you're either going to do this or we're going to get divorced because I can't stand being around you anymore. And then she came up with the name Climate First Bank, and because she said it's the only thing that matters, and if we don't get this right, we cease to exist as a species. And she and my daughter designed the logo, and we filed the charter application in 2021. And we got the charter in record time, which just kind of goes back to the regulators they really know me, of course, by now, but they were really comfortable with the values proposition. And we filed as a legal public benefits corporation. We're the first and only bank in the state of Florida to be a public benefits corporation.
So, Ken, you're coming off of this string of banks as you've described. We're curious, what are some of the core lessons you've learned in starting Climate First Bank specifically? So we're starting to wonder if it's perhaps been more or less difficult than you originally anticipated, and if you encountered any surprises along the way.
Well, Climate First was probably less difficult than I anticipated. First Green was horribly more difficult than I anticipated. But the really big curveball for Client First I mean, climate first, client first.
Well, both, I suppose.
That was an interesting Freudian slip. Was COVID.
Heard of it.
We were getting ready to file, and then all of a sudden, this global pandemic. It's like,
Yeah.
oh my God, how am I going to sell stock in a pandemic? No one's ever done that before. I'm not going to be able to go rent a hotel conference room and get 20 doctors in there and pitch them on the investment.
Sure.
But it ended up being interesting, to say the least. I mean, we subscribed for $17 million in capital in our stock offering, and we ended up raising $44 million. So
wow.
Yeah, it's a really good indicator of something.
You're talking about your success with the investors, and that's great. I wonder if we can move to some of your successes or challenges maybe in getting customers in the door. And we've seen on your website that you offer services for both personal and business clients. We did a lot of explaining in the introduction about what our listenership, these just regular people that care about sustainability, how they can transition some of their investments to maybe be a bit more ESG sustainability minded. So can you talk about who's coming to you for service, maybe more on the personal side than the business? Are they coming to you because you've got high quality service, your climate focused mission, some combination of both? Like, talk to us about the customers you're seeing come in on the personal front and what they're asking for and how you service them.
It's definitely a combination of both. It's less about ESG than it is about all of the former. Great service, a community bank, quick decision making. At First Green Bank, at the end, only about 18% of our portfolio was identifiably values aligned customers. And as you can imagine, it's really hard to figure out if somebody's values aligned.
Sure.
For a bank, it goes all the way down to our core processing system. And if the system won't capture data adequately, then there's no way to really know. And so with Climate First, from the very start, we tried to ensure that we had data systems and APIs that would allow the robust data collection. And we're still not there because, as you can imagine, on a commercial loan application, we can ask the questions. We can ask the hard questions. Do you recycle? Do you? What's your employee policies and all that kind of stuff? But on a consumer checking account, and we've got a pretty good online account opening process and all that, other than asking some questions, you don't really know. So another question I think you're going to ask is about the Net Zero Banking Alliance. We are keenly interested in determining and impacting our 1, 2, and 3 emissions. And in our own operations, it's easy. We can track it. We can immediately impact it. But how do we impact a customer? How do we measure a consumer's carbon footprint, as an example? Or when you're going all the way to scope 3 emissions, it's really tough for a bank. We had at First Green, when we sold it, I think we had 10,000 customers. It's like, it's all really pretty difficult.
Yeah. So let me ask you this, Ken. For your customers that are coming in more on the personal side, like, how do they know that they're banking with a climate forward focused bank beyond just the name of the bank? How do they feel that?
Right. And we want to make sure that they're comfortable that there's no greenwashing going on. And the best way to summarize that, my friend Vince Siciliano, who was the CEO of New Resource Bank in San Francisco, he said, a consumer wants to know where their money sleeps at night.
Yeah.
And that's really the operative question, right? And I think a consumer, they need to delve into the walk that we're walking, and whether that's a Google search and spend 10 minutes snooping around in any data that's out there. Because there's lots of articles about us and about our history. But also, I think it's very, very important that a consumer, this isn't just for us, this is for any company, a consumer looks towards certifications and stuff. Is the company a B Corp? does the company have really robust vetted certifications? Like all of our buildings, we're trying to convert or build to LEED standards, or not trying to, we will convert or build to LEED standards as robust as we can get them. We're a member of the Net Zero Banking Alliance. We are a pending B Corp, and you have to be in business a year before they'll grant it. But we far exceed the number of points necessary. We will join the Global Alliance for Banking on Values when we've been in business a year.
So you talk about all these certifications, right, that you all are a part of, and you talk about the customers doing some Google searching, but I'm wondering, do you do any direct communication to your customers about, hey, you're wondering where your money sleeps at night? We are going to transparently tell you in this email, here's where all our money's been invested so far. How do you communicate directly to your customers about what's happening to the money that has been given to you?
We do email communicate. We're working on reporting through PCAF and some other robust reporting.
What's that?
Partnership for Carbon Accounting Financials.
Okay.
And there's some out there, and there's some really good ones, as you can imagine, that have developed for, if nothing else, public accounting and audit reasons, to legitimize all of that kind of stuff. But a lot of it is a work in process, and but we do inform our consumers, and we try to use every form of outreach or advertising as a teaching moment. And for instance, we try to include on all of our advertisements what we call a green factoid, which is a fact or a way for the consumer to reduce their carbon footprint or be more environmentally conscious or whatever.
So Ken, since opening in June of this past year, I think we shared this stat in the intro, 43% of the loans that Climate First Bank has financed have been mission-aligned loans. So we're talking things like solar energy projects, LEED retrofits, and electric vehicle charging infrastructure systems. So Ken, tell us about the demand for these mission-aligned loans.
Sure.
Do you find that you have more people asking for these loans than you actually have to offer?
No, we've got plenty of capacity to provide really almost as much of those type loans as we get demand for. We have far less demand than we'd like to see. Some of that may be because we're in Florida. Some of it is because under the regulations during our first 3 years of operation, we can't really go out of Florida. So we're kind of, stuck with our own geography, if you will. But the 43% includes our rooftop solar product, which is, a slam dunk. It obviously qualifies no matter what the borrower's political predilection might be or whatever. But some of the other loans, we got them there. We got the borrowers there. For instance, we did a ALF, adult living facility, and it was a fairly large loan, and there was nothing ESG about it. And in our loan committee, one of the lenders spoke up and said, hey, wait a minute, there's 40,000 square feet of roof space in this building. Why are we just approving just a straight up real estate loan? Why don't we tell them they've got to put solar on it and we'll finance the solar 100%, so there's no money out of pocket and it'll actually save them money. And they did it. And so it worked just as planned. My dream and desire was to influence and educate. And a lot of our borrowers, they voted for Trump. They still support Trump, but we can convince them through economics that it's a smart move to put solar on their building. It's a smart move for a hotel owner to put electric vehicle charging stations because, then they're going to attract the rapidly growing population of people with electric vehicles.
Right. And so then, Ken, as I then think about the future growth of Climate First Bank, perhaps expanding outside of Florida, in my mind, that might open you up to both more investment opportunities that align with your objectives and potential borrowers that need them. Is that a part of your thinking?
Yes, sir. Absolutely. Once we get out of the 3 year de novo period, which is what the first 3 years of heightened regulatory scrutiny is called, we'd like to expand into markets where the values proposition plays well, like Asheville, North Carolina, or Austin, Texas, or Nashville, Tennessee.
Sure.
And it is a lot easier if you're in a market that's friendly. And there are parts of Florida that qualify. Our headquarters are in St. Petersburg. That's certainly a great progressive market. Orlando is good. Palm Beach is good. There's pockets.
Right.
I call them islands of lucidity.
Well, and I'm wondering, Ken, maybe on the flip side, right? I think Jay's right that maybe as you're able to go into other states, there'll be more opportunities. And it's interesting to hear you talk about how you're able to talk to potential borrowers about sustainability aspects they hadn't considered before. But I'm wondering about the flip side, where maybe someone asked you for money and you had to say no because of some of these commitments that we know Climate First Bank has. Or maybe there's been certain people that wanted to open up an account, they learned more about you, and maybe they said, actually, never mind. I mean, have you run into any of those sort of ramifications of being Climate First?
Yes, absolutely. We back at First Screen, we developed a negative filter or screen, and we have a negative filter at Climate First. We don't do dirty energy. We won't do extractive industries. And in Florida, that includes peat mining, phosphate mining, that kind of thing. We don't do porn. We don't do for-profit prisons. There's the obvious stuff that we don't do, and that's easy. It's the gray area stuff that is more difficult. And we absolutely have people that have said, I won't bank with you because I don't believe in your CEO's political beliefs, or I like mining.
Yeah.
We do have plenty of people that come to us just because of our values proposition. But a big, big issue is trying to recruit talent. And quite frankly, we don't want talent that is not values aligned with us. And I've found through the years, I often had the philosophical question and then debate among my team of, do we hire a banker with a book of business that may be a 20-year banker, a great business development person, but they're a trumper, and then we bring them along the journey in the values proposition? Wouldn't that be a good solution? Well, it would be, but it doesn't work. And I've tried it a number of times. I've had a number of high-level executives quit or self-select is the polite way to put it. In fact, I had one guy, our senior lender, walked in my office one day, shut the door, and I said, sit down, and what's up? And he said, no, I'm not going to sit down. I quit. I can't stand your politics, and I'm not putting up with it for another day. Okay, well, don't let the door hit you in the ass on the way out. And we've had people at Climate First that just came right out and said, no, I'm not going to come work for you because I don't believe in anthropogenic climate change or whatever. And that's probably best, that we know it right up front.
That's interesting. I mean, I would have thought like you thought, well, maybe there's people that don't totally align with our values, but we can bring them along. And it's interesting to hear you've tried that and it hasn't really worked. But at the same time, we have seen some news come out from you guys where you've hired, I guess, what you're calling the mighty Millennials, some new staff. So there's obviously an attraction at the same time of what you're trying to do. And we know you've hired a new Chief Talent Officer and Director of Diversity, Equity, and Inclusion, which is great. So you're doing that sort of diversity training. And again, I guess it'd have to be, you wouldn't want to hire someone who's not open to that sort of training, right? It would just bring down the whole staff. And so I get it, but it's sad to hear that you would hope that as people come on board and they see the great stuff you're doing, that, their eyes would be open, and they could probably open your eyes to certain things too. But yeah, if there's people that just aren't aligned with the values and they're not going to change, it's not going to work.
It's not going to work. I mean, we've got plenty of people that are centrists that are
sure
lifelong Republicans. have that as their values proposition, but they completely are on board with, trying to reverse climate change and diversity, equity, and inclusion, and all that stuff that we're probably the three of us on this in this conversation right now are scratching our heads, going, "I can't believe we're still talking about this, or it's still an issue." But it's really fun to see that with people when they do get on board, and a lot of it's a function of education, But do you want to talk about the millennial thing for a minute?
Please.
I love it because it's a big conversation that I think I'm going to start having in the bank, is intergenerational understanding. And we've got a fairly large number of baby boomers on our team, myself included. And we are, kind of feel a very strong camaraderie. And then we've got a large number of millennials and then a few Gen Xers in the middle. And the millennials all roll their eyes at the baby boomers. It's like, "Oh, you bunch of dinosaurs! Why can't you understand this app I told you to download?" And we're going, "Oh, you silly millennials! You can't drive a manual transmission. What are you
I
thinking?"
want to, Ken, though. I really do. I want to learn to drive stick.
And I can. So, Ken, let me just speak up for the millennials that do.
Yeah, the best thing I ever heard, I read somewhere that a manual transmission is a millennial anti-theft device.
Love it.
And with my son-in-law, that's definitely the case. With my daughter, it's not the case because she can run a backhoe. So I guess it's all in where you were raised or whatever. But I personally happen to love millennials, and I wonder how any baby boomer cannot, because they're all our children. And if anything's going to save the planet, it's the millennials. And they're on fire. They want to know where their money sleeps at night. They want to vote with their wallet. Even if they don't understand completely how to do it, they're all ears. I feel like they're just far more mature than I ever was at their age. And I find myself being willing to just turn over way more to them than say I would have when I was 40.
Jay, can we make Ken an honorary millennial?
Ken, we're knighting you with our imaginary millennial sword here. So welcome to the gang. And honestly, Ken, I've seen pictures of you online. That head of hair is enough to make you look, 30 years younger anyways.
It's nice.
Praise the Lord if you're so predisposed.
All right. Well, Ken, I do want to start asking you, though, about strategies that our definers or our listeners can take, whether they are millennials or boomers. So, first question actually for you is whether or not folks from outside of Florida can open up an account with you guys at Climate First Bank. That's obviously one step. But if not, what else would you suggest they research as they look to take care of this for themselves?
That is a fantastic question. And I've read all you guys' stuff, and all the points you bring out are very germane and also difficult. A lot of the stuff is in its infancy. As you pointed out, you need to dig deep, even if it's a legitimate metric, because it is nebulous,
right.
and a lot of this stuff hasn't been defined very clearly. And I guess I would say for your listeners, just be real thoughtful, do your research, but then look for those certifications. If a company goes to the trouble to be a legal benefits, public benefits corporation, they're pretty darn serious. If they get a B Corp certification, that's hard to get. And, they may be stubbing their toe in one particular area, or not able to turn the ship fast enough, but it means that they're doing something really right in another area. And the transition is a tough thing. I mean, there's got to be a just transition. You can't just say, I'm not banking with B of A because they're financing dirty energy. Those loans are contracts. They can't just go unilaterally break a contract. But we just got to work as rapidly as possible to change everything. And that's how daunting this task is
Right.
we have to change everything.
I think that's absolutely true. And it just involves a fundamental shift in the way we perceive the way business happens around us. But to that end, Ken, I do just want to confirm, listeners that are outside of Florida, can they yet open up an account with you?
Oh, I'm so sorry. Yes, I didn't answer that. Yes, on the deposit side, you can absolutely bank with us. You can go on our website, and it's real simple. We worked really hard to make the online account opening easy and effective. And if somebody does have a problem, we have a old-fashioned phone number and stuff, and we'll jump right on it. But yes, absolutely. And then to put in a plug for my other values-based bankers out there, there's fantastic banks elsewhere in the country. Almost all of them have good online banking.
Yeah, and that actually takes us, I think, to one of our last questions here is we want to know about the future of Climate First Bank, of values-based banks in general. What can our listeners expect to be the landscape to be in 5-10 years? Is it going to be, there's going to be branches of these sort of banks in most every big city? Crystal ball this here for us. What does Climate First Bank look like in 5 years, and what does values-based banking look like?
Well, Climate First Bank specifically, as you can imagine, I've modeled it out to 10 years and beyond, largely because I'm 64 years old and I don't have that much longer on this planet. So I want to make sure I've got a good platform to leave for the millennials.
Well, for the record, Ken, your hair disagrees, but please continue.
For 5 years, we're planning on being $1 billion in assets, which translates into $938 million in loans. So that's a lot of solar loans, a lot of loans doing good stuff. For the more esoteric investment watchers out there, I'd like us to be at $16.19 per share book value, or around $32 per share market value. In 10 years, and I hope to be public by the end of 5 years, publicly traded. In 10 years, we'll be $2.5 billion in assets,
right,
with a book value of $23 a share, hopefully a market value over $40 a share. And I'd like to be in the major cities throughout the Southeast by that point.
Mm-hmm. Well, Ken, I love your answer, and Scott, I'm smiling here because oftentimes, we'll ask guests, what does the future look like, and we'll get kind of a open-ended answer. But Ken is like, nope, I've got X, Y, and Z modeled out. I can tell you, we're going to be in the Southeast, and I think, Ken, we might just drop a quick, suggestion to come out here to Denver, perhaps just up a little bit further into DC to see locations here, because I know Scott and I are super enthused about the bank and the value proposition you bring.
Love it. Okay, they're on my map.
So Ken, as we start to near the end of this conversation, we do want to ask you our famous last question, which is our party fact question. So it goes something like this. Let's say we are at a beachside happy hour on a beautiful coast in Florida, and we're talking about personal sustainable investing. And we want to share with someone who we are sipping drinks with on the white sandy beaches. We want to share one fact with them about personal sustainable investing that will blow their minds. One statistic that will just really sink into them and convey exactly how important and how exciting this field is. So we ask you what that fact might be.
I would say the knock your socks off stat for the banking industry would be a study that was commissioned by the Global Alliance for Banking on Values that MIT performed, and they issued a white paper, and they determined that values-based banks outperformed globally systemically significant, which in common language is too big to fail, banks in almost every financial metric, and values-based banks have a very, very, very low failure rate compared to other banks.
Okay, values-based banks, they're doing well.
Love it. Well, Ken, thank you so much for coming to join us on this episode. I think this is something that I know Scott and I have been super enthused to discuss and add to that the expertise you're sharing with us today. I think we're walking out with a incredibly high quality episode that I know I will be consulting years into the future as I'm continuing to make these decisions. So on behalf of myself and Scott and all our definers, Ken, thank you for joining us, for sharing your expertise. Folks, to learn more about Climate First Bank, check out climatefirstbank.com. But again, Ken, thank you so much for joining us.
Thank you so much, guys, for having me on your program. I really appreciate it.
All right, Scott, I think it's time we wind up this episode. I think, to be honest, as banks, you seek positive interest, but the longer this episode goes, the more negative interest I think we're going to get from our listeners, right? So let's start tidying this one up.
Oh, I like that. Like negative interest, like interested in what we're saying. That's good.
Little double entendre there.
Nice. Okay.
All right. So first, we want to thank Amelia Kovach and Keaton Butler for their help in putting together all the research and audio editing behind this episode. We'd like to extend a huge thanks to Climate First Bank for putting their name on this episode and for sharing with us all the fantastic tools they're offering as a new bank focused exclusively on climate. And of course, we want to thank Square Peg Round Hole and Potions for the jams we use throughout this and every one of our episodes.
I also want to thank my longtime, very good friend, Bettina Bergu, who is an energy efficiency and financing expert who also has taken it upon herself to become very well-versed in personal ESG investing, read over our intro notes, gave us very good feedback. So thank you very much, Bettina. We also want to remind you all, hopefully you caught it during the episode, we want to hear from you where we should invest our money, including if you yourself have an investment opportunity. We can invest in you and what you're doing. So please tell us, hosts, HOSTS at sustainabilitydefined.com, or message us on Instagram or LinkedIn or one of those. We also want to remind you to rate and review the podcast. Do it on Apple Podcasts if you haven't done it yet, please. It's super helpful because it means more people can easily find us. And as a little incentive, we do read a review from somebody. And we did get one, Jay, since the last episode. We have one from, Drew Dog 1234. This was left on January 20th, 2022. I think this is the title of the review, Jay. Andrew Schoppenhurst? Right?
Something tells
Maybe
me.
that's his name. Maybe that's Drew Dog. Okay, so here's what he said. Or she, I think. Maybe he. So here's what Drew Dog said. This podcast has taught me tons about a wide variety of sustainability topics. I always recommend it to anyone who is hoping to learn more. They go into the perfect amount of material to teach something new while still being interesting. I also love how they have topics that are often left out of the sustainability discussion. Drew Dog 1234. Aw.
Oh, Drew Dog.
You should not have.
No, you should have.
You're my dog. And as my brother would say, don't dog me, dog. All right, Jay. I think that about does it. You all stay sustainable out there. I'm Scott Breen.
And I'm Jay Siegel. We will see you next time.